Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks which are buzzing in trade. I am Agam Bakil. Now, before we start with Hot Money, let's shift focus to earnings, and we have Mindtree, which reported a very strong set of earnings helped by strong deal wins. And we have Rostov Ravanan, CEO of the company, who says that no change in the outlook, but at least with respect to 2-3 years, but he is expecting the momentum to continue. Listen in.
We are very confident of the growth momentum over the next 2 or 3 years. I think the foundation has been laid very solidly over the last 2 years or so with investments in talent, investments in technology, partnerships, all of which are leading to very strong delivery, very high customer satisfaction, and that is therefore in turn leading to high pipeline, great win ratios. So I think all the efforts have gone in over building the foundation over the last 2 or 3 years, and that's leading to very confident outlook for the next few years.
Mr. Ravanan, your press release does mention some very large deal wins for this particular quarter. Can we get a better idea and a better sense of what the value of these deals is, especially the one with the aviation industry, which apparently is the largest deal you have won so far, and among many others that you have secured in the quarter?
The first one that I'd like to talk about is our new win that we announced this quarter. This is an existing customer of Mindtree in the US and in the airline industry. This customer entrusted their entire quality assurance or testing function to Mindtree. This was done through great relationship that our teams have built with the customer, and also the great delivery we have promised and we have delivered to the customer over the last few years has convinced the customer that we are the right partner when they were looking at radically redefining their testing function. So that's the largest deal in the history of Mindtree to today, multi-year, multi-tens of millions of dollars of deal. We didn't disclose the deal value due to client confidentiality requirements, but to date, that remains the largest deal in the history of Mindtree. Zooming out of that for a second, across many other customers, geographically, India, Europe, US, service line wise, whether it is digital, whether it is run the business kind of programs, we are getting a lot of traction from our customers based on the strategy and the investments that we have made. So multi-year, multi-million-dollar wins across many of our customers, across many of our segments, shows that we are well positioned when the demand environment turns in favor of more specialized players like Mindtree.
Mr. Ravanan, a lot of these investors are also extremely heartened by the fact that we've seen an over 20% sequential growth in your total contract value, and a bulk of this comes in renewal of contracts. Can you give us an idea about what these contracts are and how much of this has to do with, change in business side of things?
A reasonably large portion of our contract wins in this quarter was in the grow the business piece, in a very broad term that we define as digital. So if you look at this quarter, overall deal wins was about 300 million, of which about 102 million was digital. So our piece with our strengths on digital are resonating extremely well with the customers, and in many of our renewals we are able to upskill and get more more trust of the customer, either a larger piece where you have taken away market share from others, or change a small 1-year engagement to a multi-year engagement. So across both duration and across both volumes, we are able to get much more traction with customers today than we used to in the past.
Mr. Ravanan, just 2 more questions. The next one was on your acquisitions and the kind of contribution they have made, and the kind of contribution you expect your latest acquisitions to make, and if you can also offer us an idea about your inorganic strategy.
I think at this point of time, our focus is primarily on organic growth. If we come across any interesting ideas, we will obviously evaluate it and see if it makes sense for us from a business strategy, culture perspective. But at this point of time, the primary focus is organic growth. between the two acquired entities that we had in 2015 and 2016, both are remarkably turned around over the last few months. In the most recent quarter, both had very strong growth. One had about a 7% growth, one had about a 6% growth. Good deal wins and good pipeline momentum in both those businesses. And today, for all practical purposes, they have been completely integrated into Mindtree. So I think it'll probably not be that relevant to track them individually anymore. But at this point of time, when we ended Q4, both those entities, our package solutions business, SAP business under Bluefin, and the Salesforce business under Magnet, both did very well in this quarter.
And finally, sir, several managements in the industry are still reluctant to talk about the visibility in the banking, financial and insurance vertical. Can you tell us anything about this particular vertical and how you are witnessing trends in this particular area?
I think it continues to be in growth mode for us. We just had some client-specific issues in Q4 for the BFSI vertical. But looking forward, I think that business will do quite well. Good year-over-year growth in our BFSI business compared to the previous year. The only, I would say, other noteworthy trend that we are seeing amongst our client portfolio is that more of the opportunities that we are engaging with customers on today is in the more traditional run the business kind of work. We are not seeing as much traction on the newer technologies with our customers in BFSI compared to what we are seeing with the other industries that we serve.
Okay, that was the management of Mindtree, Rostov Ravanan, very positive with respect to the future. But now let's shift focus to hot money and let's welcome in our experts. Then we have independent market expert Dharmesh Kant and Avinash Gorakshakar, Joindre of Joindre Capital, joining us on the show. Thank you for joining us here. And today on Hot Money, we will discuss Infosys, Jet Airways, ITC, and the oil marketing companies. Let's first talk that we are looking at is Infosys, and the new CEO Salil Parekh believes that it is now time to sacrifice margins and invest in advanced technologies and skill development. And the question really is that will this strategy save the day for Infosys and perhaps lead it to better growth prospects? So let's put it out in the open to our experts. Avinash, I'm going to put it out to you. Do you think this strategy will work in favor of Infosys?
Agam, first of all, the kind of numbers which Infosys presented, post the Q4 numbers, I think there was a lot of disappointment on the margin front. I think a 100 basis point cut on the margin front was something the markets were not expecting. Otherwise, numbers were in line, and I think more importantly, whatever were the legacy issues of the previous, management team led by Mr. Vishal Sikka, I think clearly on fronts like Skava as well as Panaya, I think the markets are now considering that after a couple of quarters, we could possibly see some sort of more growth and stability coming in. But if you see the headline numbers, I think clearly our sense is that the BFSI space is something the company is looking forward to improve. And hopefully, once the US market recovers, I think there's a lot of hope that the US economy will take off and there could be more bigger, kind of client wins from the US markets. So all said and done, this is one part of the piece. And the second is on the digitization strategy. The clear intention that the management wants to focus on this year is a clear positive. So this is one area where the markets would keenly watch whether any new deal wins come in. And from the shareholders' point of view, 2 billion cash to be returned to the shareholders over and above the 70% payout of the free cash flow are definitely key positives. Right. So it's a hold. I wouldn't suggest a buy, but definitely at the current levels, one can look at a better risk-reward ratio over the next 12-18 months. Okay,
Avinash. On the whole, it's a hold, but Dharmesh, how would you view it? You are not necessarily looking at this in a positive light.
Yeah, see, as far as the new CEO Salil Parekh and his view on the Infosys is concerned, it's nothing new. So they have been trying to do this for the last 4 or 5 years. If you look at that, the transformation, the new era of digitization, that is where the struggle has been for all the top tier IT companies, be it Infosys, TCS and the others. So, and one of the biggest challenge for Infosys is the unstable management. Right. Every year and a half, if you have a new CEO coming and they are trying to again revive the thing, so the continuity of the strategy which was put in place is not there. Sure. So that struggle is there. As far as margins are concerned, margins have been coming down for Infosys. Again, nothing new there. Right. So it's not that they have been holding on to margins and now it's being depleting. And there are two reasons. One is the pricing power is not there. Second is the the employee cost is getting hiked because of the US policies in place. So these two will continue to hurt. Point is how fast they can revive or turn around.
Okay.
So I don't think so. It's the right time to turn.
Okay, so Avinash, in that case, let me just put up some of these concerns that he's also raised. You did mention about Panaya and Skava, but they are getting rid of it, and it wasn't like they were contributing quite substantially to the company's earnings either. And I know that you are neutral, you're not necessarily positive on this one. And of course, we've also had this, a little bit of, should I say, revival in the digital strategy. How would you address these?
No, I think, Agam, you're right. I think Skava or Panaya were not contributing a significant amount to their top line or profitability, but it did create a sentimental negative, because of these two deals. And I would believe that, if one were to look at Infosys, I think you need to give some more time to the new CEO. Clearly, if margins are sacrificed in the short term, but if growth in the digital space actually takes off, that is something which has to get percolated in numbers. So I would also believe that, it would be better to hold rather than making a fresh commitment. But yes, at these levels, the stock trades at roughly about 15 times FY20 earnings, which does not look very expensive, but at the same time, growth will always be a function of what kind of growth they achieve in the digital space.
Okay, there you have it, guys. Well, a neutral call on one side, and on the other hand, and not necessarily positive for certain. So that's the view on Infosys. Of course, we'll have to wait for more quarters to come in before we can start looking at, some trends building up, and on the back of that, I'm sure our analysts can decide whether or not they want to change their stance. But moving on, the second stock on the list is Jet Airways, and well, we've had the aviation data come in, and we've seen both Jet Airways as well as Interglobe Aviation lose out their market share to much smaller players. But the question we are asking right now is Jet in the position to turn its affairs around and turn its business into something which is much more profitable in comparison to what we've seen in the previous few years, for that matter? Dharmesh, over to you.
See, that has been the challenge for the Jet. If you look at the operating performance of Jet for the last 5 years, they have been struggling in spite of the various ties, be it with Etihad or Air France or their US counterpart Delta Corp. But still, they have not been able to get the operating efficiencies right. If you look at the operating margins and compare that with SpiceJet or Indigo, so they are fairly low, so much lower than what they are in the same industry, in the same environment. And crude prices are going up. Let's not forget that. What is happening in market share, Jet has been losing much faster. Indigo, it was a marginal blip this time around. Otherwise, they have been able to hold on to market share and growing there. Jet has never been able to do it. So I don't think they are able to get the strategy right in place. And aviation as a sector, you may see traction in the volumes as far as passenger traffic is concerned. But if you look at the margins, every operational flight, they are not going to improve and they are going to hurt. So every dollar increase in crude oil prices hits their margin cost by 30%.
Right.
So that's the worry.
Okay. Avinash, would you agree that they are not getting the strategy right?
No, I think I agree with Dharmesh for the simple reason that if you compare Jet with Indigo, I think on the operating metric side, Indigo definitely has done quite better in the same industry. And I think, as Dharmesh pointed out, if crude prices rise as the way they are, and we could see levels of $75, $80 a barrel, that means there's going to be tremendous pressure on the margins. Although, as you rightly said, Agam, airline traffic has actually shown a very strong traction. If you look at their third quarter numbers also, there were a lot of one-offs like forex gains or maybe sale and leaseback transactions actually contributed to their profit. So my sense is I think it's better to wait and watch, and probably you could see a little bit of negative underperformance for some time because this is a sector which is very sensitive to crude oil.
Okay, so then the real question is, considering both of you agree that Jet Airways needs to do much more to improve their prospects, then Dharmesh, what is it that they can change in the strategy so as to start competing as the way we have seen them compete in the past?
See, they have to get the operational efficiencies right, and to get the margins right, you need to, first increase the PLF. So they have been losing market share traction. So like SpiceJet is now 95% capacity they are operating at.
Right.
Jet is still below 90. Even Indigo is 90 plus. Others in the play, the smaller players are also, clocking in more than 90%. So where they are losing pricing, more or less, everybody is giving the same kind of a pricing. What is happening is the type of services which you render and the timing, flight timing. So Jet is now not so, punctual as far as, Indigo is concerned still. So those are the small things which needs to be put in place. And as far as the costs are concerned, that the management has to look into how to improve on the cost efficiencies.
All right, Avinash, would you like to add into as to what Jet can do for now?
No, I think the only strategy, what Dharmesh also pointed out was, actually improving the capacity utilization, because crude prices, frankly, Agam, are not in the control of any domestic or, international airline player. And I think if PLF, the plant load factor actually improves, and obviously they are able to, generate better yields through better utilizations of the aircrafts, that could be a better operational metrics which the markets would be looking forward, at least in the near term, as long as crude oil prices continue to rise.
There you have it, guys. Well, largely negative views from our experts. So we do have a consensus as far as their views on Jet Airways is concerned. But moving on to the third stock on our radar, and this is ITC. The real question is that does ITC make for a good bet in the FMCG space? But mind you, this is excluding cigarettes. The thing about ITC is that it's put in a lot of investments in the ex-cigarettes FMCG area, and it's not really been consistently profitable, but it is still work in progress. So that's the question we are asking: can it be out there with the top names? And once again, Avinash, I'm going to start with you. Your call here.
No, I think, Agam, if you talk about the risk reward, I think this is more like a defensive bet. I wouldn't be surprised, the fourth quarter also turns out to be more or less a steady quarter with volume growth down by say 1 to 2% and some value accretion coming in both on the FMCG and the hotel side. Our sense is that, this is not a stock which could give extremely promising returns over the next couple of years, because clearly the non-cigarette business is just into, work in progress stage, and it's going to actually take a long time before it contributes both to the top line and profitability. In fact, we have been extremely positive on the dairy space, Agam. Just to talk about the stock that is Parag Dairy. Our sense is that this is a stock which has a market cap of 2,000 crores, and we are looking at a top line of at least 2,600 crores for FY20. So it trades at a fairly attractive market cap, and the kind of positioning they have in the dairy space, the branding they have made, I would believe that at a multiple of around 16 odd times. Here the growth propensity could be much better. I think ITC could definitely make more money, but I think from a risk reward point of view, it's better to put a bet on a company which has got a smaller base and a promising sector.
All right. And Dharmesh, how about you? What's your view here?
That's the challenge on ITC for the last, so many years.
Yeah.
They have been trying to diversify themselves from cigarette to non-cigarette kind of a business, FMCG, and they have been continuously, investing. This quarter, last quarter gone by, was first indication of, green shoots coming out, when they clocked a 16% kind of a volume growth on the FMCG part. So that has to be seen how long they are going to hold on. Products are good. If you see the products, be it in the confectionery segment or other segments where they are operating, those are good on the FMCG side. Hotels is being a struggle for them, but even the hotel industry as such is picking up in India.
Right.
So that can be another positive. At the same time, paper and paper products are cyclical in business, so that there you cannot expect much. Cigarette, which was the main source of earnings for ITC, has taken a big hit, and going by the way the government is going, it will be a continued pain for them. Having said that, I think there are challenges ahead for ITC. 10-15% kind of a move can be there, but not beyond that.
Okay, so we've had a very interesting comment coming in. It's like Reliance, Industries putting in their oil and gas business in the back burner to concentrate on their telecom business. Similarly, when it comes to ITC, well, we really can't say too much about their cigarettes business because it essentially gets them the bulk of their profitability, and we've seen the major margins coming in from there. The question then is, Dharmesh, how long can ITC take before it can start generating consistent profits, margins up to the mark when it comes to the FMCG-ex cigarettes? And how long do you think the investors should wait for it before they can start getting in results in that particular segment?
See, I think ideally you do take 3 to 5 years, because FMCG as a sector grows by 10 to 12% on an average. If the everything falls into place, like monsoons and everything is falling into place, then it can be 15-16%. That's the best scenario, which they have done and which others are also doing. As Avinash pointed out, Parag Milk Foods and all, they are much cheaper. ITC is still 30p multiple, which is trading now. My own sense is that it is only cigarette which is going to lift up ITC going forward, because 10-11% of the market is only regulated. And government is, hell bent on doing all unorganized to organized kind of a transition. So they would be behind that. people won't, quit smoking. They will continue to do the smoking part. So this 80-90%, when they move to the organized player, ITC is the biggest, gainer of that.
Okay.
So that is eventually which will again be adding to the revenue. So 40-50% kind of a top line coming from cigarette division will continue to be so. So management should focus on that, and they should expect government to plug the loopholes so that smokers go into the organized segment. So that's it.
All right. Avinash, I'd actually take that point forward because at the end of the day, with respect to the government's stance, I mean, I know that they want to be anti-smoking, but at the end of the day, they are making a reasonable amount when it comes to taxation on cigarettes. That said, it is also ITC's cash crop. Yeah. If you consider that, and if you said that you prefer other plays in comparison to ITC, and the kind of margins that ITC cigarette business enjoys, do you think that something like a dairy player, as you mentioned, can be up to the mark and eventually, come up with that?
I think clearly what Dharmesh mentioned is right, that the impact of unorganized sector to the organized sector post GST is going to take a long time. And I think although the cigarette business is a cash cow business, it does not require large capex. I think volume growth is something, Agam, which is going to take a lot of time. I would believe that definitely, I mean, in terms of the shift from unorganized to organized would definitely happen. But if somebody has a 3 to 4 year view, and coming back to dairy stocks, I would believe that companies which are operating in this space have started banking and cashing on the consumerism. The branding wave in this sector has started moving. So obviously ITC will also grow, but in terms of the risk reward, I think ITC could take it a longer time where we could see in terms of returns for shareholders.
Okay, so a very quick response on only ITC's FMCG segment. You think that it's going to take a little longer than usual, and which is why you wouldn't necessarily want to bet on ITC on the back of only its FMCG segment?
I think within the FMCG sector, I think if one were to look at a pure FMCG play, there are a lot of pure FMCG companies like Godrej Consumer, which I believe could possibly outperform as compared to an ITC, because clearly in terms of the FMCG basket, they have a much larger basket to boast in the FMCG place. ITC definitely, looking at the fact that the shift from unorganized to organized is something which will happen, but it's going to take a long time. So I would prefer something like a Godrej Consumer, and clearly from an FMCG perspective, I think ITC definitely is not a pure FMCG play in that sense.
Okay, and Dharmesh, you would concur?
Yeah, definitely. Because if you want to play FMCG, it has to be mid and small cap, rather than ITC and HULs of the world.
Fair enough.
So there, Godrej is there, Jyoti Labs is there, which is again restructuring and coming out with new products. So those are the plays one should look at.
Okay, there you have it, guys. Well, that's the view on ITC coming in from both our experts, and well, largely concurrent views too. And we move on to the final stock, or should I say the final sector that we are addressing in today's show, and that is the OMCs. Well, we have seen a lot of pressure on OMCs recently, even as crude prices, continue to show an uptick. The question really is, can we start going at value hunting around this sector? Does this sector now, offer any opportunity, or well, would you like to avoid the sector completely and wait for more cues coming in? Dharmesh, I'm going to come to you. What's your view here on OMCs now?
See, nothing wrong with the sector, but this is what happens when your sector has been regulated in the past, and the sword is hanging on your head that it can be regulated anytime soon.
Right.
So that is the only reason why you are seeing such a big correction coming into the play. Otherwise, as far as usage of crude and crude products are concerned, they have been on a consistent uptrend. 10 to 12% kind of a growth is volume offtake is there. What is happening with now, the fear is, since again crude is hitting $70, I mean WTI, so the margins will get skewed because government will force them to.
Right.
The point is how long this is going to continue. Once you open up a sector again, and you never reduced your excise duty and everything, you had the entire benefit. So now when you have to pass on the benefit, you are twisting the arm of the producers.
Right.
So I'm saying, so unless this gets sorted out, so till that time, business won't give you the true return to the shareholders. That's the view. It's better avoid. Yeah.
All right, and Avinash, I'm assuming that you're of the same opinion.
No, in fact, Agam, I second what Dharmesh has said. But I think if crude prices continue to rally further, I think obviously GRMs are going to come under pressure. And clearly, I think my sense is over the next say 2 to 3 months, we are unlikely to see crude prices cooling off, because this time the crude demand is largely demand driven rather than supply. That that is not the reason the prices are moving up. Within the space, I would say, if somebody wanted to take a position on, the natural gas space, that is something which usually has a contra effect on most of the gas companies, because normally we see when crude prices go up, the gas companies definitely do well, and this is a space which is definitely, an attractive space and could offer a better risk reward.
Okay, if I can actually take you up on Mahanagar Gas and the kind of weakness that we've seen recently, what's your say on it? Do you think that this would be an opportune time to get into something like an MGL?
See, I think it's a steady cash flow generator, and most importantly, the kind of geographical reach and the kind of moat it enjoys in the business agam. Our sense is that in the near term, it may have a little bit of a slow kind of move, considering that earnings growth over the next, say, 12-15 months are going to be sluggish. But if one were to look at crude prices of around $80 a barrel, people are obviously going to look at cheaper, fuel options like a CNG or a PNG, and that is where I would believe Mahanagar Gas, say below 900 odd rupees, definitely qualify as a good kind of value buy if one were to look at the next 2 years.
Okay, Dharmesh, so you're clearly not in favor of OMCs. In that case, would you place something like the RIL ONGC basket, or would it be city gas distribution companies?
Definitely not ONGC basket, because even they have the same headwinds.
Right.
If crude prices are going up and they have to sell into India, they have no choice but to compensate to the government. ONGC always has this overhang of subsidy thing coming back to them.
Right.
So RIL is a different play altogether. It's a different basket, and you should not, now compare RIL with the OMCs or the upstream companies. So that's in a different league altogether. So that's a clear buy to me, RIL. City gas distributor does stand a very good chance. So they are long gestation period kind of a play like MGL and all, and this will be future. Clean energy is the future, so gas distribution will take, but it will take its own sweet time, 3 to 5 years for new geographies to be entered into, and natural gas prices will come down going forward, because the the technology which was used to extract them has improved significantly, and that has brought down the cost substantially.
Right.
So my own sense is MGL, if somebody wants to hold it for 3 to 5 years, it's a multi-bagger.
Okay.
With the type of return ratios it have, the type of margins it enjoys, it will continue to do so, and it would be more of a monopoly kind of a business.
Right.
So it's a best choice.
Okay, there you have it, right? Well, absolutely avoid the oil marketing companies for now, and well, you can look at something like city gas distribution companies. In this case, both our experts are agreeing on MGL in the long term. But we've run out of time on this show, so I'm going to thank both our experts, Dharmesh and Avinash, for joining us and taking us through their views in the discussion. And with that, it's also a wrap on today's Hot Money. But don't go anywhere. Ask BQ is up next, so stay tuned in a Bloomberg Quint.